It feels like we're stepping into a new era, a modern gold rush. There's something in the air lately. You can almost feel the rush. Everywhere you look, it's gold headlines, gold charts, gold fever. It's like the world suddenly decided gold is the only safe harbor left. And if you clicked on this video wondering whether you're missing out, you're in exactly the right place. I'm an investor like you, not a gold expert, trying to build something steady, something that can last, even when the world feels like it's falling apart. Today, I want to share how I'm thinking about gold right now, without the hype or the fear. We'll walk through why gold is soaring, where it actually fits into a smart portfolio, and why the real opportunity isn't about rushing in. It's about thinking differently. Let's talk about what gold's surge really means, where it gets tricky, and how you can use it, not chase it. Gold prices have exploded lately. Between global uncertainty, inflation fears, and all the talk about trade wars, it makes sense. Gold feels safe, gold feels solid, gold feels like an escape hatch. And there's a reason for that. Gold has been a trusted store of value for thousands of years, surviving wars, financial crises, and hyperinflations when currencies collapsed. Unlike paper money, it's not tied to the fate of any single government or central bank. When inflation erodes the value of cash, or when geopolitical risks shake confidence in financial systems, gold has historically stood firm. It's the asset people turn to when they don't know what or who they can trust. But here's the trap. When everyone runs into gold at once, it often means emotions, not strategy, are driving the move. During the COVID crash in 2020, gold spiked, tumbled, and surged again. A vivid demonstration of how fear can create wild swings in markets. That period highlighted a deeper pattern often missed when focusing only on the short term. A closer look at historical data, particularly a chart tracking gold's behavior through past crises, reveals how gold typically moves during extreme uncertainty. When fear peaks, gold tends to surge sharply. But the real opportunity often belongs to those who remain steady beyond the immediate chaos. There's a recurring pattern that shows why patience, not panic, defines successful gold investing. The real magic of gold isn't about getting rich quick. It's about anchoring your portfolio when the winds get rough. If you think of your investments like a ship, stocks are your sails. They catch the wind and move you forward. Gold is your ballast, the heavy weight deep under the water that keeps you steady when storms come. So when I add gold into my portfolio, I'm not chasing fireworks. I'm making sure my ship doesn't tip over, even if the headlines make it feel like the end of the world. And that chart I mentioned earlier, it traces gold's biggest historical moments, from the 1970s inflation boom through the 2008 financial crisis, and into the COVID-19 pandemic. In each case, gold surged sharply when fear peaked. But the real story isn't just the initial spike. After those dramatic rises, gold often experienced short-term pullbacks or sideways moves that shook out the impatient traders. Yet, for investors who stayed calm and held their gold positions through the next cycle, the rewards were significant. Over multi-year periods, gold prices continued to climb as uncertainty lingered and monetary policies shifted. This pattern shows why trying to time the top usually backfires, and why steady hands, not fast feet, are what gold truly rewards. And it's not just individual investors piling in. Central banks around the world are quietly adding more gold than they have in decades. China is aggressively increasing its reserves to reduce reliance on the US dollar and to strengthen its financial security amid rising geopolitical tensions. It's part of a broader strategy to slowly challenge US economic dominance and prepare for a more multipolar world. India is doing the same to buffer against currency volatility and external economic shocks, especially as global inflation and political risks rise. Other countries, particularly emerging markets, view gold as a shield against potential sanctions. The freezing of Russia's dollar reserves in 2022 sent a clear message. Assets tied to the Western financial system could be vulnerable. Gold, by contrast, cannot be frozen or politically seized. Even traditional U.S. allies, like Japan and parts of Europe, are cautiously diversifying. Not because they expect a sudden collapse, but because in a world of rising debts, trade wars, and political noise, it simply makes sense to hold an asset beyond anyone's control. For many central banks, gold is now their insurance policy against inflation, sanctions, currency devaluation, and an increasingly uncertain global system. They're diversifying away from the dollar, one quiet shipment at a time, quietly preparing for a future where financial resilience may matter more than ever. If they're thinking long-term, maybe we should too. So what happens next? The road ahead for gold is shaped by powerful forces. Inflation expectations are rising again, partly fueled by new tariffs and ongoing supply chain pressures. Surveys like the University of Michigan show that consumer inflation expectations recently spiked to 4.3%, the highest levels since 2022. Historically, when inflation lingers above expectations, gold tends to find strong and lasting support. At the same time, the US dollar has weakened meaningfully, with the dollar index falling below the symbolic level of 100. A weaker dollar tends to push gold prices higher because gold becomes cheaper for investors holding other currencies. Meanwhile, the Federal Reserve is now under pressure. Futures markets are pricing in the likelihood of 75 to even 100 basis points of rate cuts by year-end. If rates are lowered to support economic growth, the opportunity cost of holding gold drops, making it even more attractive compared to bonds or cash. On the geopolitical front, risks are building. Escalating trade wars, rising protectionism, and the shift toward a more multipolar global order. In uncertain times like these, gold often acts as a universal safe haven, immune to political games. Of course, even with all these tailwinds, gold isn't invincible. After sharp surges like the one we've seen, it's normal for gold to cool off temporarily, to consolidate, catch its breath, and build a new base. The key isn't guessing next month's price swings. It's about positioning yourself thoughtfully for the next decade, understanding that true investing resilience means living through the noise. I'm not buying gold hoping to win this year. I'm holding it because I want to stay standing no matter what happens next. In recent years, some investors have turned to cryptocurrencies like Bitcoin, hoping they had found a digital gold. And during certain periods of inflation fear, Bitcoin did show signs of acting like a hedge. But when true fear hit the markets, whether during the COVID crash, inflation shocks, or sudden geopolitical tensions, Bitcoin often behaved like a high-risk tech stock, falling dramatically alongside broader equities. Gold, by contrast, has consistently stood apart. It has survived centuries of wars, currency collapses, and economic upheavals. It doesn't rely on server uptime, exchange access, or network consensus. It simply exists, trusted globally, valued universally, and immune to political or technological vulnerabilities. Cryptocurrencies may evolve and mature into a more resilient store of value over time. They represent an important frontier in financial technology. But today, when real-world uncertainty strikes and trust in systems breaks down, gold remains the proven safe haven, a role that digital assets are still striving to fully achieve. Gold can be a part of your peace, but real peace comes from how you invest, not what you chase. And if you want to go even deeper into protecting your investments against uncertainty, check out my video, Market Crash: How You Should Protect Your Portfolio. In that video, we dive into practical strategies for staying resilient even when the market feels anything but calm.